I'm John Fenoglio. I'm with CBRE Capital Markets here in Houston. Just a quick note, CBRE is the largest real estate service firm in the world. 31,000 professionals throughout the Americas, Asia, Europe, and here in Houston we've got 650 professionals housed in the Williams Tower in downtown as well that serve a wide variety of customers and clients in the marketplace. I just joined in March, and as I told someone, I've been drinking from a fire hose ever since, just learning all the many activities that they are involved in, and it's been a great experience for me. I'm going to talk about the real estate commercial capital markets today and tell you what's going on, and the same themes that Cliff was alluding to, and some of the same trends as far as peak amounts of capital that were in the marketplace in 06 and 07 fell off a cliff, and with the credits totally freezing up in 09, and now we're coming out of it. And that's a consistent theme all the way through on the debt and equity markets. Let me define the total commercial real estate capital market. It's about a $3.5 trillion marketplace that's about 2/3 leveraged. At the end of 07, this capital stack was about $4.5 trillion. So it's shrunk as property values declined, as loans failed, et cetera. But it's clawing its way back. Let's go to the debt markets and look at those first of all. There's about $2.37 trillion of outstanding commercial real estate debt in the marketplace. The biggest owner of that debt are the banks and the thrifts. They have about 34% of it. The second largest is at 24.2 are the securitized lending sources, the CMBS, CDOs, and asset-backed security market. And again, that's a market that froze in 09 and is making a comeback. The next largest component would be the agencies, Fannie, Freddie, HUD, and again, a growth sector. And then you've got the insurance companies that love commercial mortgage debt, always have. It's always been an important component of their portfolios. And then you've got just some other lenders, the mortgage REITs, the private debt funds, et cetera, that kind of make up the balance of it. Let's look at who's lending today. Insurance companies put out about $45 billion in 2011. They're expecting higher allocations this year. They're on pace to equal, if not exceed this. Many of them invested heavily in the first half of the year, and several have been on the sidelines, but they're actually getting new allocations now, so they're coming back. These loans tend to be more conservative. Many cases, large loans and portfolio loans are in great demand by the insurance companies. Their underwriting is very conservative, but they offer great rates today. The CMBS market is stepping up again. This is a market that at the peak in 2007 put out $230 billion worth of lending. It was 2/3 of all debt in the commercial real estate market. It died in 2009. It stopped. It froze. Everybody got laid off. It is now coming back, and it's coming back slowly. They did $33 billion last year. Year to date, we've done about $25 billion, and things are coming back. Their rates are a little higher than the insurance companies, and these rates have actually come in since these slides were put together. I'd say they're more in the 4.25 to 4.75 range today for a good loan. They'll do a little higher loan to value than an insurance company. The insurance companies are 65. You might push them to 70. CMBS will take you up to 75%. And there's 15 active lenders in the marketplace, and a couple others that are also in the process of jumping in. Banks are back. And what's unusual in this cycle is that the banks, especially in our part of the world, are offering basically 5 to 7 non-recourse loans, which is something they never did in the past here. They did it in other parts of the country, but many times best execution is going to a bank on a stabilized asset with a good cash flow. It's just going to a bank, getting a loan that's 5 to 7 years, it's priced over LIBOR, and then swapping the rate, and you can have a very competitive interest rate. This is a new phenomenon, and I think Hank will get into this a little bit, but they want to get the money out. They want to get it working, and they want it on good assets. So they're going after the best borrowers, the best assets, and offering this. They're still doing construction lending, but construction volumes are not what they had been in the past, and this is a way to get the money out the door, which is what many of the banks need to do. Fannie and Freddie are very much alive and well and continue to be the dominant source of multifamily financing. They did $40 billion in 2011. They're on pace to do more than that this year. They'll lend virtually in all marketplaces. They are getting some competition now from the insurance companies and other lenders that are chasing some of this. Pricing, and I'm not going to spend a lot of time on this, but the insurance companies are going to be, for low leverage, 50% debt, 5-year term, you can actually break 3% today for the right deal. 10-year money is going to be in on low leverage 3.8 to 4.4. You move up the leverage 60 to 70%, and you're up about 25 basis points from that standpoint. How's the debt behaved? You can see we had this goes back to '96. Defaults were nothing until about '08, and then the blue line is the CMBS spiked. A lot of the debt was bad, and today those delinquency rates remain at around 9% of all the debt. And there was about $760 billion worth of CMBS paper that was created, and this is an industry that only got started in 1994. So 9% of it is still causing some heartache right now. The bank's commercial real estate portfolios have about a 3.5% delinquency. Most of that's in construction loans. Their loans on their owner-occupied and other existing real estate are performing much better. The construction loans, and most of those are legacy loans from that '06, '07, '08 era, are causing the heartaches. Interestingly enough, Fannie, Freddie, and the insurance companies have remained sub 1% on default ratios. These lenders knew what they were doing, and the paper has behaved very well. Let's look at what are some of the challenges going forward. You can see we've got about this year about 150 billion of maturities, loans coming due. Most of those are CMBS, and then as you go out, beginning in 2015, we get a spike, and these are 10-year loans that were created in '05, '06, and '07 that will be maturing. And we've got a big maturity bubble coming out here. And if you add up kind of what the capital flows are today, we think this year there will be in the debt markets probably somewhere around 150 to 160 billion. And you can see we're going to cover the maturities okay and other transactions, but we're going to need more money going forward to meet these big maturities that will be coming, and we need the CMBS market to really get going again. Just talking about, again, where's the stress in the marketplace? This is basically these metros accounted for 67% of the distressed and potentially distressed assets. New York, Los Angeles, Vegas, and South Florida kind of lead it. And you can see Houston's well down the line from that standpoint. So things we did not take the hits that we had in past cycles. Let's look at the equity markets real quick. The real estate equity markets are estimated to be 1.15 trillion. Again, the big players there are the private equity funds and the REITs, each having about 33% market share. You've got basically pension funds at 13%, foreign investors at 12%, and then insurance companies, private financial institutions, and public untraded funds with 1%. This is a slide that's hard to read, so let me summarize this for you. This is fundraising by the private equity funds. Again, the trend being big spikes in '07, slowing down, and they really haven't come back. Just to summarize, these are quarterly figures. $131 billion was raised in '07 by private real estate funds. That fell to $45 billion in 2010. We did $54 billion in '11. And the fundraising today, year to date, is about $18.3 billion. That compares to $25 billion in the first half of 2011. So a lot of people in the marketplace, and one reason why the money isn't being raised, it takes longer. You can look at this. It only took 8.8 months in 2007 to raise a real estate equity fund. Today it's 19 months. Before we leave that, there are currently 452 funds in the marketplace trying to raise about $154 billion. So it's not for lack of effort, it just takes a lot longer to tell the story, pitch it, and go forward. Let's turn to the private investors, or excuse me, the foreign investors. This is the 2012 planned investment. You can see is an increase over 11. The 11 actual investment was an increase over their expectations, and the U.S. remains the majority marketplace where foreign investors are going to place their funds. Ranking where they want to invest in the United States. The gateway markets lead the charge. New York, Washington, San Francisco, Boston, LA, and Seattle. What's different this time around is Houston is the next, once you get past the gateway or the bi-coastal strategies, Houston is on everybody's radar screen right now. And so granted, we don't have the majority of the money coming our way, but we're there, and we are considered now one of the top investment markets for both domestic and foreign investors. Turning to the REITs, they continue to raise a lot of money. They raised a total of $33 billion in the first half of this year. That compares to $51 billion in all of 2011. And so they're on pace to raise a lot more money, and their balance sheets are in good shape, and we continue to see them to be major players. These public non-listed REITs, which really mom and pop investors, can put $1,000 into these deals, are continuing to raise money. They've increased from $1.6 billion to $2.5 billion in the first quarter, and we still see a lot of these coming to the marketplace raising money. Pension funds continue to shift monies from stocks and bonds into, quote, alternative assets, and real estate remains one of the major portions of that. State pension funds over the past five years have shifted 10% of their assets from public equities to alternatives, with 32% being real estate. J.P. Morgan Asset Management recently published a study saying that you'll see real estate move from 5 to 10% of assets up to as high as 25% over the next 10 years. So the quest for yield and really good performances by commercial real estate, it continues to attract money from that standpoint. So where's the money being spent? What's the activity? Well, again, here's your typical consistent graph showing activity falling tremendously in '09 as far as sales volume. Right now, our total real estate sales are basically at about $108 billion for the first half of 2012. That's a major increase. We're not back to the levels of 2007. We're far from it. Our sales activity now are on par for around about 2004 volumes. Money is disciplined and is behaving well, and it's being attracted to the core assets and to the opportunistic assets. Anything in the middle, there's not quite as many players bidding for it, but you get a big central business district office building in one of the gateway markets, you're gonna have the thundering herd beating your door down. So who's selling, who's buying? Well, the sellers tend to be the private sources, private funds, private money. Institutional equity has been selling this year. Listed REITs have been doing some selling, and then some of the foreign investors selling. Who's buying? Well, some of the same. The private investors are buying, the institutional funds are buying, and the REITs are actually net buyers this year. So it's a good, consistent mix, more or less along the lines of the ownership. So what are we going forward? What are we worried about? Well, we've talked about it a little bit. We've got a little bit of debt ticking away out there that eventually has got to be dealt with. Rates are behaving very well now. We're a safe haven. We're selling treasuries at record lows, but this is building. No telling how far back, how much more's been added since I printed this the other day. Others concerned, Europe. Our CMBS markets were shut down the second half of 2011 because of the concerns in Europe, because investors felt like there was going to be another Lehman-type meltdown, so it's still a concern. I'd say I agree it's not as bad, but it's still something everybody is looking over their shoulder at. We've got a fiscal cliff, debt ceiling we're going to have to deal with here soon. We got an election coming up that will also probably change the tone, whoever wins. So let's sum up what we have. Interest rates and cap rates are at historical lows in the commercial market. Commercial real estate capital is available, but it's disciplined. There are no reckless sources of capital as in past cycles. And I've been doing this 40 years. There's always a gunslinger out there. I will tell you there isn't right now, yet. Overbuilding is not on the horizon due to large equity requirements and disciplined lending practices. We have a total right now probably of 16 to 20 office buildings planned on the west side of Houston. There's only 3 under construction. And all of those are being built predominantly out of equity. A couple of them are all equity deals. Another one, there was another asset pledge to get the deal out of the ground. There is discipline. There is not going to be overbuilding due to reckless capital from that standpoint. Core assets are in great demand by equity investors and lenders. And then the other side of the barbell is the opportunistic and distressed assets also are attracting a lot of the equity. Anything in between, you just don't have as many people chasing it right now. The low yield on alternative asset classes, stocks, bonds, et cetera, keep commercial real estate as a favored asset class as yields have proven to be higher than other assets. Houston is, we've got favored nation status. Everybody wants to be here. Our job growth is the big story in commercial real estate. Job growth drives demand for commercial real estate, and we are on everybody's radar screen. It's a great, in my 40 years of doing this, I've never seen a great harmonic convergence of low interest rates, great supply-demand fundamentals, and great job growth. We've got a great thing going, and I'm very bullish that this is not just a flash in the pan. I think it'll last for a while. The tepid national economy will also keep us in this favored nation status, and one thing I've learned over the years, these conditions will not last forever. You never see it coming, so get it while you can. Thank you.